Something that our team has wanted to experiment with for quite some time now has been to create a weekly show where we look at some of the most interesting charts about the financial markets as well as the broader economy. So we thought, since we're doing so many other shows already, why not give this a shot as well? Now, please remember, this is only experimental and we know that this can be a lot better. So please do watch it and give your feedback in the comments. By the way, we still don't know what to name this show, so we would love to know suggestions from you in the comments. We have two very exciting rewards for this. The first reward is for the person with the funniest name suggestion, and the second reward is for the person whose name actually gets picked up by us. Also, if you like this show, every week we'll curate interesting charts and then explain what is happening in the markets and the economy using them. The idea here is to make it a little more visual so that you get a broader context as compared to what you get from Daily Brief and our show called The World Simplified. Also, you can see and download all of these charts in high quality from our newsletter, which we have linked in the description of the show. That said, let's start with the first few charts which give you a sense of how the Indian markets are doing currently. From their peak, Nifty large, mid and small caps are down to the range of 7 to 8%. But underneath the indices, the market breadth seems to be getting worse. To explain things in very simple terms to you, market breadth tells you how the market as a whole is doing in terms of how many stocks are going up and how many of them are going down. Now, one way of looking at market breadth is to look at the number of stocks that are making 52-week highs. From about 330 stocks that were hitting 52 weeks high on an average, the number has now fallen to 217. This shows that there is a lot that is bleeding if you look inside the market underneath the indices. The other way to look at market breadth is to look at the advanced decline ratio. Now, the advanced decline ratio is a market breadth indicator which gives you a sense of the overall health of a stock market. This compares the number of stocks that have increased in price to those who have decreased over a specific time period. A ratio greater than 1 here indicates that more stocks are advancing than declining, and it suggests a bullish market trend. But on the other hand, a ratio that is less than 1 indicates that more stocks are declining, and it suggests a bearish trend. Now, as of now, the current ratio is about 0.6, which suggests that the market breadth has deteriorated. We then also got a little curious and looked at the drawdown of Nifty 50. To give you some context, a drawdown tells you how much the market index has dropped from its highest point to its current or any other subsequent lowest point. Now, Nifty 50 is down about 7.8% from the peak. The last time Nifty fell more than 7%, to give you context, was in March 2023. Our team then also looked at the 10 biggest one-month falls, and the current Nifty fall of 6.5% in October 2024 does not even make it to the top 10 list. We have seen far worse in the past. Now, considering the fact that our markets have gone up almost in a straight line, so to speak, this is not that dramatic, but nobody knows what will happen to the markets in the future for sure. The next thing we look at is how much cash are mutual funds holding. Someone called Akshay on Twitter asked us how much cash are mutual funds holding. As of September 2024, equity mutual funds had about 1.76 lakh crore rupees in cash. This is about 5.8% of the total industry equity AUM. Now, before you start thinking if mutual fund managers bought about 1.76 lakh crore worth of equities, Nifty will go to 50,000, hold on. See, mutual funds typically hold about 5% of their money in cash. The reason for this is that on any given day, they will have redemptions and they will use this cash to meet them instead of having to sell their portfolio. Some schemes obviously end up holding higher amounts as well. To give you an example, Parag Parikh Flexi Cap Fund, which is one of India's largest Flexi Cap schemes, holds about 18% of its portfolio in cash. But this is an outlier. Most mutual funds are in the range of about 5%, and right now, the 5.8% of the industry equity AUM is in cash. Now, the best guess here is that it will slightly reduce in October, given that the Nifty is down about 6.5% in this month. Then let's look at foreign institutional investors. The foreign institutional investors had been on a buying spree so far in 2024. If we leave out October, India has seen net FII inflows in 6 of the 9 months until September. But something definitely changed in October. As of October 22nd, 2024, FIIs have sold stocks worth almost 80,000 crore rupees, which was the highest ever selling in 1 month and even surpassed the massive sell-off that we saw in March 2020 during the COVID-19 pandemic. Now, like I also covered in one of the recent Daily Brief stories, though the the Indian markets have fallen by about 7 to 8%, we haven't quite witnessed a massive sell-off, and the reason for this can be largely attributed to domestic institutional investors or DIIs, which are mutual funds, insurance companies, pension funds, etc. And these have bought stocks worth almost 83,000 crore rupees and have offset whatever the FIIs have pulled out. But there's also something very interesting that we read from White Oak Mutual Fund. While the absolute number of 83,000 crore rupees looks very, very big, if you look at it as a percentage of market cap of the Indian stock market, the outflow is only around 0.2%. Now, this is far lesser as compared to what we witnessed during the 2008 global financial crisis, when FIIs pulled out as much as 1.5%. But still, the question remains, why exactly are FIIs pulling money out of India? Look, while it is anybody's guess, there are a few reasons for this. Valuation concerns, global economic factors, disappointing corporate earnings, and the biggest of all, China. Chinese markets have started attracting significant interest from foreign investors once again after it announced a stimulus package to boost its falling economy. Let's now shift gears a little bit and look at some interesting macroeconomic trends that ITC had recently shared in its quarterly presentation. Now here, things look a little bit worrying. Food inflation has remained persistently high, which is hurting consumption choices of households. Excluding the base effect outliers in July and August 2024, food inflation has remained consistently above 7% for the rest of the year. There also seems to be some diverging trends between urban and rural consumption that we had also covered in our Daily Brief episode very recently. Passenger vehicles, cement production, and other high-frequency numbers, coupled with the results of FMCG companies, points to a weakening urban demand. But at the same time, good monsoons, tractor sales, falling Manrega employment, two-wheeler sales, and commentary from FMCG companies are definitely pointing out to a revival in rural demand. Now let's shift gears once again a little bit and talk about debt mutual funds that have hit a bump while equity still remains strong. Look, after seeing net inflows of over 1 lakh crore rupees in the previous 2 months, the mutual fund industry has seen net outflows of about 71 lakh crore rupees in September. Now this was due to outflows of over 1.13 lakh crores in debt funds. To put it very simply, debt funds like liquid funds are used by big corporations for their treasury management. This means that they use it for parking idle cash, given that short-term debt funds are relatively safer and a little more liquid. September, being the last month of the second quarter, is also when advanced taxes are due. So companies usually sell their investments in debt funds and use that money to pay off advanced taxes. And this is not only in September. As you can see from the chart on the screen, we have seen most outflows in the final month of each quarter, which is June, September, December, as well as March. Even if we count out the month of October, apart from some minor hiccups here and there, the Indian equity markets have practically gone up in a straight line this year. And this shows up when we look at net inflows in equity mutual funds. So far, we have seen net inflows of around 2.75 lakh crores. The last 5 months especially have seen constant inflows of about 34,000 crore rupees. While net SIP inflow numbers aren't quite available, the gross inflows, which by the way do not account for any redemptions from mutual funds, have been on a steady rise since 2021. They have hit new highs almost every month ever since, and that has coincided with a massive bull run in the Indian markets. Now, while this is good for the markets and for investors as well, it remains to be seen whether we will see the same enthusiasm when the market sees a meaningful correction or will go on an extended period of moving nowhere. Now, when the markets are scaling new highs like IPOs, even NFOs are enjoying the party. September was the 5th consecutive month when we saw NFOs collecting over 10,000 crore rupees. Most of these new mutual fund schemes are thematic funds which track specific sectors or themes like defense, electric vehicles, consumption, commodities, etc. When the broader market does well, these funds also do well. But when things go bad, these funds can go a long time underperforming as well. Now, this may also be currently happening in certain hyped up themes like defense. Now, since I just touched upon the topic of IPO, Hyundai Motor India launched its IPO, which is the biggest India has ever seen. Despite so much buzz, it saw a massive undersubscription from retail investors and received only about 50% of subscriptions in the category. But things still sailed through thanks to institutional investors, but the listing was not quite a huge success. The shares ended down by over 7% on the listing day itself. Now, a small fun fact for you here is that out of the 10 biggest IPOs in the recent times, only 3 of them have managed to give out listing gains. With over 54,000 crore rupees raised by companies until August, 2024 has already been a bumper year for IPO fundraising, even without accounting for the 27,800 crore rupees from Hyundai. But that said, even if the markets continue to trend downward, we may see fewer and fewer companies launching IPOs going forward. But despite this, 2024 is still set to be the second best year for IPO fundraising. For companies that are raising funds through small and medium enterprises platforms, it has already been the best year. SMEs have raised a record of 5,600 crore rupees until just August this year. And mind you, the year is still yet to end. All of this is thanks to the raging bull market we are in, and it shows in the numbers as well. The BSE SME IPO index is up about 100% year to date, while the Sensex is up about 10%. Now let's shift gears once again and talk about changing investor demographics. Post-COVID-19 pandemic years have been a big boom for the markets. And this does not just mean in terms of appreciation and asset prices. Over the last few years, Indian markets have seen massive increase in participation from young investors, which are those people who are below 30 years old. Before the pandemic, this number was just around 23%, and now it has almost doubled to about 40% as of August 2024. Now let's move on and talk about gold. Of course, everybody loves gold. From 2021 to the end of 2022, gold was trading sideways, so to speak, and it then broke out. This has been one of the best performing asset classes ever since then. In fact, this year, gold is up 22%, while the Nifty is up only 11%. This also shows up in the flows. Gold ETFs have seen steady inflows from 2023 and have picked up pace in 2024. Year to date, gold funds have seen 7,200 crore rupees of inflows. And it's not just retail investors, central banks are also loving gold. Central banks are buying gold at an unprecedented pace. As of quarter 2 of this year, central banks have bought about 484 tons. And even if you simply double that for ease of calculation, central banks are well on track to buy close to 1,000 tons of gold. Last year, they added 1,030 tons to give you a point of reference. Now, the fact that gold has become one of the primary choices for central banks to add to their reserves says a lot about how they see the world today. The World Gold Council recently published a survey of central bankers, and it had some great fascinating insights. About 88% of central banks regard gold as a dependable store of value and inflation hedge, while 82% think that it adds stability during financial crisis moments. Now, right now, as geopolitical tensions rise and inflation remains a concern throughout the world, gold has become quite popular. Gold accumulation is the most noticeable in China as well as Russia, which have expanded their gold holdings significantly since 2010. But more interesting is the change in attitude towards Western central banks. 57% now expect to raise their gold holdings, up from 38% last year. This comes at a time when there are increasing questions about the US dollar status as the global reserve currency. Now, interestingly, about 62% central banks had predicted the US dollar's proportion of global reserves to fall over the next 5 years or so. So that brings us to the question, is there de-dollarization? Look, yes as well as no. Central banks are indeed buying other non-traditional reserve currency assets which are denominated in Australian dollar, Canadian dollar, Chinese renminbi, South Korean won, etc. But this is not to say that there is de-dollarization. It's just a case of increased diversification, so to speak. If you notice, the fall in the dollar share has not quite led to a big increase in the share of pound, sterling, yen, and euro. Now, while we're already on some global context, let's shift gears a little bit more and talk about whether this time it'll be Trump or Harris as the US president. So the US election is just about 10 days away now. Both Donald Trump and Kamala Harris are neck to neck, so to speak. Now, considering that the next US president will have a huge impact on global economy as well as the Indian economy, it is worth paying attention to what will happen. To give you a quick sense, Donald Trump's economic agenda for a possible second term is focusing on a few main areas: trade protectionism, tax cuts, deregulation, and energy independence. A central part of his plan is significant change in trade policy. He has proposed universal tariffs of about 10 to 20% on all imports and even higher rates of up to 60% on Chinese goods. Trump believes that these measures will help protect American jobs, support domestic manufacturing, as well as lessen dependence on foreign products. This will have massive implications for the global economy. Now, to give you a contrast, Kamala Harris's economic agenda focuses on strengthening the middle class and addressing key affordability concerns. At the core of her plan is a commitment to cut taxes for over 100 million working and middle class Americans, while also simultaneously lowering costs for everyday necessities. She plans to raise the corporate tax rate to 28% and increase taxes on high income earners using additional revenue to fund her proposed programs. Her economic agenda includes a significant focus on industrial policy and aims to strengthen American manufacturing and competitiveness in key industries such as semiconductors, AI, and clean energy. We also looked at a few polls, and they are all saying different things. This is the first prediction from Polymarket. Now, by the way, Polymarket is a blockchain-based prediction market platform where people can bet on the outcomes of future events like elections or sports games. Think of it as the wisdom of the crowd, so to speak. Now, users buy and sell shares in different outcomes, and the share prices reflect how likely people think each outcome is. People place bets using cryptocurrencies, and when an event concludes, the market settles and they pay out winners based on the final results. By the way, in case you're wondering, this is not legally possible in India. Back to it, all the current bets on Polymarket are predicting a Trump win. Nate Silver, and please don't mind my pronunciation if it's wrong, is one of the most popular election pollsters out there. To oversimplify things, his model creates an average out of a bunch of other polls in a sophisticated statistical way. According to his model, Kamala Harris holds a very slim lead, and that has been steadily falling since the second week of October. Another average of polls by Real Clear Politics shows a very similar close call. But ultimately, we all have to remember that polls have been wrong and still can be wrong. A British statistician named George Box put it very perfectly when he said, all models are wrong, some are useful. That brings us to the end of this episode. I hope you found this valuable. Please share your thoughts in the comments below because we would love to know what you think and improve the show accordingly. Also, don't forget the naming competition. We have two interesting rewards, one for the funniest name suggestion and one for the name suggestion that actually gets picked by us. I'll see you in the next episode. Take care and goodbye.